Greetings, Nebraska, and welcome to the 2021 weather market, which is already shown to be rather volatile and quite crazy sometimes. And that all makes sense to us because, like we say here in the slide, grain cupboards are bare. Can the world produce its way out of current supply issues? And the answer is possibly, but the likelihood of that we think may be less than the market thinks. So the summary is not much change over the last 60 days, but we are in this full-blown weather market now where every millimeter of rain is counted or lack thereof is counted. But we do know that old crop stocks to use in the world and in the U.S. will be record tight. The USDA, in fact, has already printed record low exporter corn and soybean stocks to use. And we think that's a big driver of world grain and oilseed prices already, so that shows recent strength in the old crop markets and also the old to new crop spreads, and all of this makes sense. So record production is needed to build inventories at all in the next crop year, and even then we think stocks rise only modestly, and that assumes by far record production in South America next winter. We're also uncomfortable with the current pattern, uncomfortably low precipitation recorded so far in the growing season across vast swaths of the major grain belt in the U.S. And so this means that regular rains are critical in July to maximize yield potential. We don't know what yields will be or what soil moisture will be on August 30th, but we do know that it now has to come from the sky in a lot of places, including a lot of Nebraska. There are also issues across the Black Sea region. The dreaded Sukovia event, where very hot, very windy conditions can decimate crops very quickly. It's not full-blown, but there is abnormal heat impacting crops in Ukraine and southern Russia. And keep in mind, Ukraine is the fourth largest exporter of corn, so we really have no tolerance for yield loss in the U.S. or in the Black Sea region. Biofuel demand growth is back and is anticipated throughout 2021 and 2022. This is mostly centered on soy oil's demand draw as used in renewable diesel and biodiesel long term, but even ethanol is coming back as driving patterns normalize, and we just don't have a lot of ethanol stocks from which to draw upon. China's need for feed imports are also very real, and so the biofuel demand and Chinese demand combined to allow demand growth to return, and that is important and very different from recent years, in that weather-based rallies don't make us uncompetitive, but because there is demand growth, we need every bushel of yield possible. And rationing, if needed, perhaps via drought, outright drought and heat during the month of July, will be difficult. It has been shown historically that rationing on a global basis, corn and oilseed supplies, is difficult, but post-COVID economic growth and consumer optimism is what's unique to this market. So we have this dire need for elevated food production, whether it's meat, dairy, vegetable oils. And so as the world comes back to normal and we don't have a lot of old crop stocks, this will combine to give us, we think, a very exciting market. We lean bullish, but also we do know that their volatility will be extreme. The market has demonstrated that the daily price range is $1 in soybeans, and the average price range over the last 2 weeks in corn has been about 20 or 30 cents. None of this changes until we know crop size, so expect these wild swings in the market to continue. But as I mentioned before, the cupboards are bare. So we do know that based just on USDA data, that corn and soybean stocks to use in the major exporting countries is record low. Corn exporter stocks to use just below 7%. Soybean exporter stocks to use just below 5%. And these are levels that we haven't seen before in history. And this sort of assumes a record large South American soybean production, while Brazil's catastrophic corn yield failure this year does lend support to the global corn market. But we don't have a lot of things to draw upon for next year. So anything that we use must be produced over the next 12 or 14 months. And even assuming by far record production of corn and soybeans in South America next year, the exporter stocks to use don't change very much. So compare the 2021-22 projections of about 8% in both corn and soybeans to the recent range, up to 15% in corn and 13 or 14% in soybeans. So these are not markets that are well supplied. It will take several years of production exceeding consumption before everything normalizes and we get back to those price ranges that we saw, just 1 year ago. And this is exactly what we're talking about. And in fact, volatility in corn and soybeans has been rather tame historically. This all makes sense once stocks and stocks to use in an old crop position is very tight or historically tight. You get these big swings in the market because every bushel of yield counts, every bushel of demand counts. Even small changes in the perception of supply and demand have an outsized impact on price. So we think corn's range this summer ultimately reaches $2 to $2.50. So we want you to be prepared for that. But overall, I think our message to everyone in Nebraska and elsewhere is that a lot of this supply risk has not gone away just because the market has retreated and because USDA balance sheets show adequate supplies for next year. So our balance sheets are different, and we'll spend some time just on this. So we have old crop corn stocks at 850, new crop stocks at 700 million bushels. Both are historically low in terms of outright stocks and stocks to use, and that's important. And notice in the new crop balance sheet that we're on board with the USDA's production figures. So we don't have any material differences there. And in fact, we're a little higher based on higher seedings. But this assumes a corn yield we've never seen before, record high, which we are already doubtful of just on the margin based on dryness in places like Nebraska and Iowa, the Dakotas and Kansas, the Pacific Northwest for whatever it's worth in corn production. But what's different really is our old crop carryover number and new crop demand. We are much higher on total consumption in both years. And so that if the market is not on board with these higher demand numbers, it kind of misreads everything else. So then yield loss is not as big of an issue to the market for now. But once demand numbers are actually realized and the market is more attuned to actual consumption, then I think it will start to pay closer attention to even just drought where it is in place now. Soybean balance sheet, the numbers are different, but the story is the same. Really just pipeline low ending stocks for both crop years. And again, this assumes a near record yield in soybeans, and our acreage number ultimately this year is just a little bit higher. But it's the export and crush numbers that really draw down inventories and absorb any production gain or yield gain at all. And so again, like corn, if the market doesn't have its demand idea right, then it does misread day-to-day weather issues and yield potential. So we'll now talk about why we are different and why our demand numbers, especially for new crop, are higher than the USDA. So based just on simple arithmetic, the pace of corn sales and shipments is still very much above what's needed to meet the USDA's forecast. One of the bigger issues in the market this year has been weekly and monthly FGIS inspections only catch about 92% of what is actually exported, and that is true for corn and soybeans. So if you're doing your grids based on the FGIS numbers, you're missing a lot of bushels. So to meet the USDA's old crop corn export figure, we only need weekly FGIS inspections of about 39 million bushels. And so we've been doing 55 to 60 million for a long time now, peaking at 90 million bushels in early April. And so just based on this arithmetic, the USDA is still 200 million bushels too low with its forecast. And corn, again, old crop, this is just down to simple arithmetic. We're driving at levels comparable to 2019 now. So as long as ethanol production sort of accounts for 10 or 11% of weekly gasoline use, we're already on track to use 450 to 435 million bushels of corn per month for the remainder of summer. And that is just to keep ethanol stocks unchanged, and they're already very low. So we only need 425 million bushels of corn used for ethanol between June and August to meet the USDA's forecast. So ultimately that number is probably 50 or 75 million bushels too low, just based on consumers driving normally, post-COVID economic growth. And breaks in the market are too incentivizing ethanol margins. And really it is the goal of the ethanol market to increase stocks by increasing production because miles being driven are going to be very close to pre-COVID levels. I mean, we've already seen that periodically since the latter part of winter. And so D's corn where it is, and ethanol at $2.40 a gallon almost, the simple calculation, this is based on futures, we'll never know specific ethanol plant balance sheets, but this basic calculation, comparing apples to apples, gives us a margin of about 60 cents per bushel for spot ethanol production, and that jumps to about $1.55 implied for new crop. So December corn, as lofty as it is, record high prices for the first part of June anyway, is very cheap in the domestic marketplace. There's still a lot of incentive to boost coverage on breaks. And ethanol margins where they are today, if they stay this way, we can see the USDA being forced to raise its new crop ethanol demand draw by 200 or 300 million bushels simply because the margin is there. DDGs and corn oil are also adding value to ethanol margins. This is not included in the futures-based calculation. But DDG prices have corrected from recent highs, but still are way, way above where they have been historically. And that's partially because of the lack of ethanol production during COVID and rising competing feed grain markets. But this is all value added to the ethanol plant. Cash corn oil is at record levels because of the rally in soy oil and increasingly because corn oil can be used as a feedstock for this new renewable diesel product, which unlike biodiesel does not have any known impacts on any kind of engine and is chemically very, very similar to other petroleum products. So, and with the tax credits in place nationally and in states like California, there's just a lot of incentive to boost renewable diesel production and consumption, which we'll get into in just a bit. But for those reasons, cash corn oil prices are at record high, and this is also value added to the ethanol plant. So the incentive to boost ethanol for now and over the next 12 or 14 months is very much intact. So we're building demand on breaks. We've already sold a record amount of corn for new crop delivery as well. The commitments as of mid-June for new crop delivery are 605 million bushels. 450 million bushels of this is to China, but other importers too have been willing to extend coverage on breaks in new crop futures. So pace analysis does not really work before the season begins, but we do know that there is structural demand intact for U.S. Crops for delivery beyond September. And that is where the U.S. market is still competitive with every other country. So while exports will be slowing during the summer months, the potential for new crop exports is still very, very big. And China does not have the reserve grain stocks to sell in the next crop year. That is one way they have, in some measure, fought food inflation is by selling these massive reserves they have of corn, wheat, and rice. But as those have been sold already, that is not available during the next 12 or 14 months. So what China has will be based mostly on production and what they can import from the world marketplace. And that's going to be sizable. Their hog herd is back to pre-ASF levels, and the cash corn price in China is still close to $11 or $12 a bushel. So December corn at $5.50 gives them an incredible margin, and so we don't see any reason why their demand is not slow. And so they've bought about 14 million tons from the U.S. so far. Ultimately, that number gets to 25 million tons or so, and from all origins, whether that be Ukraine or to a lesser extent Brazil. We think China will import close to 35 or even 40 million tons of corn in the 21-22 crop year because they really do need it. And our export estimate of 3 billion bushels is not unreasonable given growing global grain trade. So I know we're 600 million bushels higher than the USDA and higher than a lot of the marketplace, but in the grand scheme of things, this is not that unusual. So our number, assuming higher total world corn trade because of China, is really only about 38% of global trade if we export 3 billion bushels. And so if you notice in this graphic, as recently as 2015 and 2017, our share of total world corn trade was even higher than we are forecasting it to be in 21. So this is not an unreasonable number when looking at the entire pie of global corn trade. And two, keep in mind that Brazil's drought is not even fully in the marketplace yet, with the USDA forecasting their production at 98 million tons. We still think it's closer to 90 million tons. So you have this 8 million ton reshuffling of global trade. Brazil exports most of its corn in the September to December period, so that just overlaps completely with our new crop sales. So we think new crop U.S. corn sales during the autumn, early part of winter will just be incredibly large. And this highlights that. This is not just drought impacting corn in Brazil, but this is one of the worst droughts on record. So this compares to 2021 on the left and 2016 on the right, the most recent major drought year. You can see that drought actually is a little more expansive this year. And in some places, some really important places, we saw almost no rainfall from April to June. So that encompasses really middle growth to pollination. So as long as corn needs water to survive, that corn is very much in trouble. And so those crops will be revised downward further. And that all that production loss goes into the U.S. export campaign in the new crop year. And again, we mentioned Chinese corn still perched above $10. This is the most actively traded futures contract in China. And so breaks in December corn, like the ethanol margins, do give Chinese corn importers more incentive to buy additional supply. So it's important to know the Brazilian corn market is not breaking. The Chinese corn market is not breaking. ethanol margins get very big on breaks, and Chinese corn import margins get very big on breaks in the Chicago Board of Trade. And the same thing too with soybeans, and why we think demand is being understated, at least from the USDA's initial estimates, is that there's this incredible incentive to crush. Spot crush margins are not terribly great, and that's mostly because of weakness in meal. And we have seen that so far, the crushing industry is not willing to ramp up rates just based on high oil prices, but it's the meal that we crush for in the US. So that has not been fully realized yet. But when looking out at November soybeans and how that fits into the product market, there's futures-based calculation of $1.45 per bushel for October onwards. So there's this incredible incentive to boost domestic soybean use at current prices. And so you only really tamp down soybean margins, even assuming the product markets stay unchanged, at something like $14.50 to $15 November soybeans. Weather aside, there is just room to grow up based on end user interest. Soy oil industrial use. We've long talked about the coming renewable diesel production surge, and the USDA is on board with it so far. So a record 12 billion pounds of soy oil will be used for biofuel production. This is partly biodiesel, but mostly this renewable diesel program. So eventually, do we run out of soy oil if we can't meet biofuel consumption with higher crush rates? And so that is a real risk over the next 2 or 3 years. And we start to think then about the soybean market, not in terms of bushels used or pounds used of soy oil, but how many acres does it take to satisfy this growing need for domestic use? And we think the goal of the soybean market long term, over the next couple of years, is to add another 3 or 5 million acres. And that's the only way this problem gets solved. So soybeans aren't going to materially boost acres, against spring wheat at 750 and corn at 550, with upside risk still intact. So you do have this significant battle for acres. And at what price does the soybean market need to go to really expand the land in production? And that's something that we think higher prices, attracting 5 million acres or so that was lost before 2014. We need to get that land back in use to meet biofuel demand growth. And this is just a list of planned capacity and when they start. So it varies from 2022 to 2026, but lots of capacity are going to be put online to produce this new renewable diesel. You also look at some of the companies, Phillips 66 for one, and these larger energy companies too getting involved in this. So the soybean supply this finite supply will be competed for by not only Cargill, ADM, and Bunge, but increasingly these large refineries, Phillips 66, Royal Dutch Shell, they're all on board with these tax credits at least, and it is sort of a government incentive program, but there's money to be made. And so there's lots of money being poured into this new renewable diesel product, which can use anything as a feedstock, but soy oil will factor greatly into what is used. And again, China's resurgence in their hog herd. They've come back almost entirely from devastating ASF, and so now they're these high-tech skyscrapers where pigs are produced and processed. So this is just an example of one. 840,000 hogs per year, 7 stories, beautiful landscape even. This is not the only one. This is not unique. But these are being built all over the country, and so they're really commercializing their hog industry, and that we think also changes feed rations, and that they're not backyard hogs anymore, but they're going to be using strict diets of soy meal, corn, and other feed ingredients. And I think on the margin that will boost Chinese feed demand as a whole for the next couple of years. And to meet that, or at least patch over their current stocks, maybe their projected increases in production, is going to take sizable or record imports. That is the only way that food inflation will be solved in China over the next 24 months or so. And like corn, our estimate, 2.2 billion bushels versus the USDA's, under 2.1 is really reasonable based on world trade. So really assuming no change in the USDA's new crop global soybean trade number, our number is just 35% of world trade. And we've seen that really every year but the last 3 of the last 4 years. So assuming China stays active, world trade growth continues, our exports of 2.2 billion bushels is not unreasonable, and it actually fits very well into the historical trend. Now, South America could change this, but not really until next May or June when their crops are fully gathered. And we know that weather has been favorable, and they do produce a record crop of 145 million tons, something that's never been seen before. So none of this is really solvable in the near term, but requires not only record yields here, but also record yields in Brazil and Argentina and Paraguay. And so, taking this all, into account, we think that there's been kind of a resetting of food prices, and this also is important for the livestock operations in the Central Plains. So our abundance of food, we spend, only 7% of our income on food, and that makes us the world's cheapest supplier of food to our domestic population. So the question that we have is, as we have moved past COVID, does this number need to go up? Will consumers spend 9% of their income on food? And if that's the case, we can see food prices rise as a whole for a long period of time. And that's kind of been, I think, the goal of the livestock and dairy markets is as restaurant traffic builds and people start to eat more and waste food more in restaurants, do those markets need to keep pace with feed grains? Should there be adverse weather and $7 corn, $15 soybeans? I think that the livestock and meat and dairy markets simply have to follow feed ingredients higher because of our growing need for elevated food production. And we can see already that disposable income, partially because no one was spending money during COVID, hit record levels. And so we think that that has a big impact on the kind of food consumed and how much of it is consumed, especially with respect to meat consumption. And more of that disposable income very quickly is going back to eat at restaurants. So we've finally done it collectively. Restaurant traffic, as measured by OpenTable, exceeded 2019 for the first time since COVID began in the middle of May. And now it's pretty consistently at or slightly above on a day-to-day basis. So does this get to 5 or 10% above 2019 by late summer and early autumn as consumers are just so excited to do other things and using part of that record disposable income, higher spending on food and going out to eat? And again, this works back into the need for more butter and cheese and meat, vegetables and vegetable oils. And the beef market and the livestock market so far has responded better than expected. So not only does it take really no break in markets to clear inventories, but we've seen a surge in a lot of the cutouts in beef prices. So this clearly is following seasonal trends to some extent, but it has been no doubt exacerbated by higher disposable income and more consumer spending very quickly as this post-COVID world starts to evolve. Slaughter margins are incredibly profitable. I know this is sort of a hot button issue, even at the level of federal politics, but there is room for livestock prices to go up. It's a matter of convincing packers to pay up for them, but they're in no way losing money at the moment. And so we cannot rule out even unseasonal rallies in pig and cattle prices, feeder and live both. There's just so much room for the market to go up, and we think that it will compete, especially given corn's discount in out months, 2022, and that's sort of one of the pitches that we've got is that if we are resetting food prices, is 480 D22 corn very, very good value. A lot of that will be determined by weather in the month of July and August, but we think as a risk management, it does make sense to use those breaks to get some level of coverage, especially given forward livestock prices, at least into the first and second quarter of 2022. Jan and April beef production, clearly a record level, and again, those additional supplies were absorbed very quickly and at higher prices. So that is the definition of a demand-led market. And that is what has allowed livestock prices to hold in much better than expected, despite, at one point, $7 plus corn and $16 soybeans. Just isolating June, cattle slaughter margins are incredibly profitable, second only to last year. But this, too, just gives you an idea of the level of beef demand at higher prices. And again, a demand-led market where there is room for the livestock markets to go up. And so even the cattle spread, just academic more than anything. These are just arithmetic, but nothing really unusual. And again, this is because I think that cattle prices must compete with rising feed grain prices long term because we do need the additional consumption. This is not something that we can draw down stocks to meet or the consumer preferences are unchanged, but they're actually consumer preferences are for eating more food. And that's not just in the U.S., but that's also the world. Beef exports until last week doing exceptionally well. And again, so the demand for beef at higher prices is intact, not just here, but everywhere in the world, including China and a lot of East and Southeast Asia. We do think that the market's at the upper end of fair value, and so we do like hedges locking in Q4 live cattle prices, and December corn at its current price, anything less than 530 is no doubt a buy. I think margins there are probably the best that we can do. So, anything above 135 and, out month cattle, and anything below 540, 530 in December corn make very, very good economic sense to us. And so extrapolating that further, I know we don't have a lot of visibility on the second half of 2022 in livestock prices. But again, thinking about December corn below $5, it just seems that those margins will work very, very well, because this need for food is not going to go away in just 12 months, but this is kind of the new normal. And these will be new prices because, again, our theory is that we have reset and are resetting the price of food in the U.S. and in the world. And this just shows, too, again, somewhat academic, but the feeder cattle corn ratio, very simple, has collapsed because spot corn is very, very tight. We might learn that it's even tighter than we think once the June 30th stocks report is out. But looking out Q4 2021 and Q2 of next year, a much more reasonable ratio. And so we don't want to get caught in some kind of loop where we are expecting the corn market to drop back to $4 or less. That probably doesn't happen for another 2 years, and that in turn hinges upon production exceeding consumption by a wide margin over the next 1 and 2 crop years. So we want the livestock industry to get used to and start risk management plans based on around $5 corn, and if we can get lower than that, then that is the place to act. And again, just everything that we look at seemingly tells us that the world does need food. So even U.S. dairy, which is only recently competitively priced with Europe and Oceania, we were seeing record monthly exports. March and April both set records for those particular months. And we think the break in dairy recently also will encourage record large exports for those months again, second half of summer, early part of autumn. So the milk market also needs to compete with rising feed grain prices. So that is what is unique. And that is what is good about a demand-driven market, is that until everyone is satisfied, that only then do we determine that crop prices are too high, and that is not current prices. And then we get into the details of weather, and it's a mix of haves and have-nots. We have sort of fine-tuned our corn pollination dates really across the U.S. to July 10, 24. So there's your 2-week period that demands for moisture will be the highest, and also the market will be most sensitive to every millimeter of rain that is forecast and that actually falls. But knowing that we can't really accurately forecast or predict weather, beyond 5 or 7 days, we do have some broad trends that are concerning to us relative to the USDA's yield forecast, which again are either record or very close to record large. So Iowa June rainfall, May June rainfall, assuming the 7-day forecast verifies, is just going to be just under 7 inches, and this rivals that of 2012. And so the difference between recent dry Junes in 2012 is that the rain did come back in July. And so that is going to be absolutely critical, because we know that if it doesn't, the moisture just simply won't be there come pollination. And that's something that a lot of people are worried about, farther west and north of Iowa as well, where, they're not projected to get much rain over the next 10 days. So we think that, net soil moisture loss continues. And already, based on, any fundamental measure, subsoil moisture is at or very close to zero across a wide swath of the Corn Belt, probably some 40% of seeded area, and soybeans too, and about 100% of the spring wheat area. So we know that rainfall can save crops, and we can see pretty good yield, but it has to rain. We cannot draw upon existing soil moisture like we have in the last couple of years. This chart 1 year ago in the middle of June showed abundance of soil moisture, really everywhere except the Rockies and westward. So we're looking at a very, very different yield potential come July, especially as moisture demands rise and temperatures also rise, which really is most likely. And so here's the current soil moisture anomalies. And the reason that we're concerned is that a lot of the climate forecasts, which we'll get into in just a bit, are still very warm to hot during the month of July and August. And it's very simple, straightforward, nothing too clever or complex. It is just a matter of that where soil moisture is very low currently, the most probable scenario is that ridging and heat and dryness returns to those areas, because you don't have this feedback loop of abundant moisture, humidity, pop-up showers. You have the reverse of that. And so it is the adage that drought begets more drought. And long-term guidance has been consistently warm and hot. And actually, we're impressed at how well the forecasting models have done in the month of June. So there, heat and dryness was forecast in June. It was early as mid-spring, and that really came to fruition. So that for one, gives us a little more confidence in continuing to look at these computer-based forecasts. So here is the U.S.'s computer model forecast for temperatures during the month of July. And so again, this just outlines where soil moisture is short. Currently, heat does resume. And even some of the near-term forecasts have heat coming back, as early as the middle or end of next week. And so that also gives us confidence in this overall warm to hot climate pattern, briefly interrupted by tropical storms like the current week. The EU model, a totally different computer system, has a very similar forecast, and it highlights where drought is. It most likely will be very hot again during the month of July. So the consensus from all the forecasters, whether private or computer-based, are very, very warm to hot across the plains and far western Midwest, with Iowa split down the middle. And that is going to be a key signature of the markets over the next 30 days, is when and where in Iowa does it rain and how much. Because the odds are for drought intensification elsewhere further west. The East does very well, but when added together, this is negative to U.S. national corn and soybean yields. And our own private climate scientist that we have on retainer, who's also done a very good job this year, just so we know the risks that we're looking at when we make day-to-day decisions on whether to sell or not in any given market. Despite soybeans losing $1 in a day and corn down 20 cents on Tuesday, this is what we're looking at in the future. And this, again, shows us the consensus that this is probably going to be a hot, dry July and August, especially west of the Mississippi. So here is the week 2 forecast, June 27th to July 3rd. We move into July 4th to the 10th. Heat expands, dryness expands. July 11th to 17, heat and dryness still intact. And so given we're already using much more water across the plains than expected and what is normal for this time of year, all of this stuff, assuming these forecasts verify, get much worse. And so will the water be there for reproductive stages in corn and then in soybeans 30 days after that? And that's a big risk to us, because if you recall just moments ago, our balance sheet still did assume those USDA yield forecasts, which are very, very high. So this is very bad in the context of needing record yields. Again, like I mentioned, just rationing global consumption has been very difficult. We saw it in 2012, and high prices were partly behind that, but that's also probably just mainly due to the U.S. residual use of corn being dropped because the crop size was so low. Otherwise, the trend is pretty clear, and it's higher every year based on population and income growth. So this year that will be exacerbated as economic growth explodes in a lot of parts of the world, including the developed world. So as those incomes stay elevated and food consumption rises and food production is needed, it's just be very, very difficult to know at what price is that last bushel of corn worth, should weather prove adverse over the next 45 to 60 days. And soybeans very similar. In fact, there has not been much rationing at all outside of 2008. And so the trend is pretty clear, steadily higher over the next 5-10 years. And does this get exacerbated by the need to crush for oil in the U.S. and across the world this year? So that is what we're up against. The markets have been fairly tame and muted over the last couple of weeks, but in no way have we solved or know that we solved any part of the U.S. balance sheet. First is Mother Nature, but then will be the rate of consumption and new crop positions, and we think that will be very, very elevated. So we will be patient in adding to sales. Weather is priority number one, and we should know in the next really 10 days if that heat is very likely to come back across the western 2/3 of the U.S. crop belt. And again, finally, these are numbers that we have compiled, and so our price forecasts are much higher than the USDA, but that is not the most important part of this. We just wanted to highlight the slope of this curve. So as stocks to use get very, very tight, the price changes against supply and demand changes are exacerbated significantly. So notice that just a 2-bushel difference in yield is worth $1.50 in the season average cash price. So as stocks to use is getting very close to zero, price gets very close to infinity, and so that's what we'll be up against. And that's why the market broke $1 recently, and that's why the market can add $1 if July weather and August weather prove adverse. Those ranges are going to be the new normal over the next 3 or 4 months. And the same is true in corn. Stocks to use is not quite as close to zero, but even just modest yield changes, we can go from $6 cash price to $8 cash price very quickly. And this just makes good economic sense. This is just the world that we live in now. So we can't avoid the volatility. We also can't say that the highs are in or that these problems have been solved just yet when the most important part of the growing season lies just ahead. And especially in parts of Nebraska, you're kind of ground zero for expanding and intensifying dryness. So we absolutely need to know what we produce as a nation before I think highs are scored. And also, individual farms, it can be very hard to manage risk until you have a better idea on your bushels. And so we advise, again, patience in adding sales too aggressively. So that is it. It's going to be a very, very exciting summer. The only thing that can be said with certainty is that volatility and wild price swings will continue. But again, we did want to make sure that clients know the weather adversities that are likely in July and how those fit into the need for record yield. So we don't think it's over yet, but we do expect very, very big price swings. So again, here's my email. If you have any questions at all, please reach out and we will do our best to answer them. But I hope everyone has a wonderful evening, and we'll talk soon. Bye-bye.